In 2022, the World Cup generated billions before the first match was played, months in advance while stadiums were still empty, through agreements negotiated years earlier. By the time the opening whistle sounds, most of the financial outcome has already been structurally determined. This is case number 7, how football became a financial system. For most of the 20th century, football clubs were local institutions. Revenue was primarily physical: tickets, concessions, and local sponsorships. Stadium capacity imposed a ceiling, so geography limited growth. Broadcasting existed, but it supplemented attendance. Clubs negotiated deals individually, and cash generation disparities reflected stadium size and geography. Then television shifted from accessory to necessity. Live sport offered something other programming could not: real-time attention at scale. In 1992, England's top-flight clubs reorganized into what became the Premier League. The structural change was decisive. Media rights were sold collectively under long-term agreements. The league transformed fragmented rights into coordinated scarcity. Satellite broadcaster Sky committed to a contract worth hundreds of millions of pounds, a figure that exceeded previous domestic deals by a wide margin. Television revenue became predictable, allowing clubs to plan expenditures against guaranteed media distributions. Wages and transfer fees increased as clubs began spending against future seasons. Spain later centralized its broadcasting model, with Italy and Germany implementing variations. At the international level, FIFA had already refined a similar structure. The World Cup evolved into a global commercial property rather than merely a tournament. Television agreements and sponsorship rights were packaged and sold years in advance, with contracted income centralized and later redistributed. Between 2019 and 2022, FIFA reported over $7 billion in revenue for a single World Cup cycle. Media rights contracts accounted for the largest share, followed by marketing partnerships, while ticketing represented a comparatively minor portion. Football's primary product shifted from attendance to attention. Aggregated and pre-sold, that attention behaves like inventory. When Cristiano Ronaldo returned to Manchester United in 2021, the club's social media following surged by millions within days. Commercial partners recorded immediate engagement spikes, and shirt sales reached record levels. Individual players functioned as global media accelerators within the broader commercial ecosystem. Predictable global audiences created reliable income streams that could be modeled, pledged, and leveraged. As capital flowed into that structure, scale became imperative. When media revenue became central, domestic leagues began thinking internationally. Kickoff times shifted for Asian markets, preseason tours expanded into the United States and the Middle East, and digital platforms entered negotiations. Clubs were no longer competing only for local supporters. Ownership structures adjusted accordingly. Traditional benefactors, often local industrialists or community figures, were gradually replaced by investment groups. Private equity firms evaluated clubs as undervalued global media assets with scalable revenue potential. Sovereign wealth funds entered the market. In 2021, a consortium led by Saudi Arabia's Public Investment Fund acquired Newcastle United under Premier League approval. The acquisition marked a shift from ownership to capital access. The club gained access to funding levels no longer constrained by stadium revenue or local commercial capacity. Spending power increasingly reflected capital availability rather than regional economics. At the same time, a new model expanded. Multi-club ownership reduced volatility. A player signed in Brazil could be developed in Belgium, sold in France, and eventually monetized in England, within the same corporate structure. Player development, resale timing, and cross-league transfers were integrated into a coordinated asset strategy. In accounting terms, a player is treated as an asset. Transfer fees are amortized over the length of the contract. A €100 million signing on a 5-year deal appears as roughly €20 million per year in the accounts. Longer contracts reduce annual accounting impact, enabling further acquisitions and strengthening competitive position. The framework increasingly relied on growth assumptions. Future media income justified present liabilities. Some clubs issued bonds, while others borrowed against anticipated broadcasting distributions. Credit assessments centered on contracted media income, projected distributions, and cash flow visibility. Audience scale influenced credit capacity. This transition introduced fragility. Commercial inflow concentrated at the top. The Premier League's global rights deals outpaced other leagues, widening spending gaps. Clubs outside elite competitions increasingly relied on transfer profits for sustainability. Talent migrated toward capital concentration. Competitive balance shifted accordingly. Regulatory response followed. UEFA introduced financial fair play regulations requiring clubs to limit losses relative to revenue. Player transfers between related clubs required valuation, a process inherently subjective in football markets. The outcome proved more complex, with legal appeals and accounting debates following. Regulation attempted to restrain acceleration, but incentives remained aligned toward expansion. The unresolved question grew clearer. What happens if growth assumptions stall? In 2020, stadiums closed and matchday revenue disappeared almost immediately. Broadcast contracts were renegotiated under strain. Season suspensions disrupted payment schedules. The operating model faced its first synchronized interruption in the modern media era. Wage bills and debt obligations remained fixed while cash inflow paused. Some owners recapitalized through equity contributions. Others relied on short-term credit facilities. The core revenue structure did not collapse. Broadcasting contracts resumed once competitions restarted, even behind closed doors. Distribution partners and sponsors required continuity. The system bent, but it did not fracture. Transfer spending temporarily declined, then rebounded. In subsequent windows, global expenditure exceeded previous records. Younger players commanded premiums reflecting long-term value projection. The rapid recovery reinforced investor confidence, accelerating expansion. FIFA expanded the World Cup format, increasing available broadcast inventory. The revenue projections for the 2023 to 2026 cycle rose accordingly. Clubs intensified global branding strategies. Streaming platforms negotiated directly for domestic and international packages, while technology firms pursued data and analytics rights. Global audience data became direct inputs in financial modeling and valuation. At scale, the sport operates as an interconnected financial network layered onto competitive play. Cash flows were forecast years ahead, risk distributed, assets amortized, and revenue securitized. In some cases, future broadcast distributions were bundled and pledged in structured financing arrangements, converting multi-year television contracts into immediate liquidity. While the pitch remained central to the narrative, sustainability was determined by the balance sheet. This was the cash files. Case is now closed.